We're going to do an email next, and this one's from Michael. And Michael asks, "What are the panel's thoughts on Imdex? The stock seems to be, they seem to be moving towards the oil and gas sector and trading below book price. Have they been oversold, and do they have a medium to long-term future?"
2 points. Firstly, like a lot of the resource service companies, Kim, the valuation is a lot higher than the share price. But the problem is the outlook for the sector is horrendous. And what I should say is the Bureau, Michael, the Bureau of Resources and Energy Economics came out in May with a forecast that the spend in the resource and energy space was going to decline from about $270 billion per annum in 2012 to about $70 billion per annum by 2017. So approximately a $200 billion or 75% decline over 5 years. So the problem is that the space looks extremely cheap, but all you're going to do is be buying it for a trade. And with trades, it's very hard to get both sides of the equation or both sides of the ledger right. So as long-term investors, we're just not playing that game because the outlook to us looks so appalling.
The next phase that's going to be interesting in this sector is going to be the merger and acquisition phase. And,
well,
I think we're just about at that point,
yeah,
where a lot of the juniors and even the mid tiers are looking at each other saying, well, there's only one way that we're going to survive this, and that is that we have to bulk up.
Yeah, well, we thought a lot about this, Kim, but the problem I have is that a lot of these small to medium-sized mining service and resource service companies are contractors, and so if they have trouble picking up additional work, then what's going to happen is that they're just going to end up being loss-making, and then eventually their balance sheets fall apart, and then eventually they won't be able to even service their original contracts. So the very, very large mining services companies, such as, for example, Monadelphous, may end up picking up those contracts by default, and they may not even have to merge with some of the smaller players.
Craig from Sydney is our next caller. Welcome to the program, Craig.
And panel, thanks for taking my call.
Glad you tear yourself away from the cricket.
I've had a holding in Blackmores for some time, and I've enjoyed a pretty good run in terms of price growth and dividend payments.
Yep.
But recently it seems to have taken a bit of a turn. Does the panel have a particular view on the outlook of both share price and dividend yield?
Interesting question, because we looked at this stock earlier in the year when it was $33, $34 and thought, it's trading on a high multiple. Dividend yield was quite reasonable. Had the leverage to Asian growth, but the question mark was always how it was performing in the supermarket channels where it was getting dusted by the big retail chains, and of course it had made that acquisition of bioceuticals, which was supposed to deliver earnings, which it doesn't seem to have done. We've now had an earnings downgrade of between 7 and 10%. So the question is now, around $27 is a good value. How much upside do you reckon there is in this stock with the Asian growth strategy? Because this is the big thing that they've been telling the market. They've been rolling out the sales force in Thailand, Singapore, China, and they're sort of saying the complementary medicines business in Asia is going to be bigger than Ben-Hur. It was a bit like Foster's years ago saying you could get every Chinese person to drink a can of VB.
Yeah, or wear a pair of woolen socks. Yeah. Look, Craig, we're a little negative on Blackmores. We have a valuation in the low $20 area and have done so now for about 9 months, and so we've avoided this one. 3 reasons. Firstly, we've noticed the cash conversion ratio is not what it was. I think Ben touched on the second point, that is the deterioration of the balance sheet. And by definition, what's happening is that their incremental return on equity is actually starting to decline, even though their equity is now more highly geared than it used to be. I mean, I don't deny it's been a superb business, but I think it's now under the pump to some degree. And I think the third point is that Swiss, according to our analysis, is outspending Blackmores in advertising and marketing within Australia, which is Blackmores' home ground. They're outspending them. We think something like a ratio of about 6 to 1. So we think that Blackmores, probably have seen better days, and we think that there is a reasonable chance that over the foreseeable future, low $20 area is not out of the question.
at $26, $27, it is certainly looking interesting. Whether or not you
know. Well, what I think's happened is because it's had this sort of superb trend for 10 years or a long period of time, and then it just sort of misses it once. People think the trend will re-energise itself over the next 5 years. And our argument is that the cash conversion ratio, the relatively less high quality balance sheet, the pressure that it takes a long time to pick up serious market share in Asia, get your distribution in order, takes a long period of time. All those points to us just point to a scenario where the valuation is lower than the current share price.
Mike from the Gold Coast is our next caller. Welcome to the program, Mike.
Hello, thank you for taking my call.
Happy to.
Just a mining services company, Delta, DSB.
Yep.
They were selling for 34 cents. They've increased their workforce. Their last dividend was increased, and they're giving a yield of 11% franked. I'd just like your view on it and what the future is for coal.
Good, interesting question on the future for coal. I'd have to say, the first thing I'd have to say, Mike, is I'd be a bit sceptical of that 11% franked dividend, because that's probably a historical trading dividend, and you want to see where those earnings were coming from. But so the bigger issue with the coal price is what's happening with shale gas at the moment. And of course, where shale gas prices go is going to dictate what happens to, to a large extent, to the price of thermal coal. Yeah. And I can't see any bright spots on the horizon for at least thermal coal for quite some time.
Yeah, I think also what's frightening is that some of the very large coal companies have obviously cut their contractors out of their own jobs, and then what they're doing is they're even cutting their own staff. And we've seen some very large announcements on the back of 2 or 3 coal companies slicing hundreds of staff. And so it seems to me that if you're a contract miner, the work that you had yesterday might not be around, and probably will not be around to the same degree tomorrow. And even if it is around, I'm absolutely sure it'll be on a much lower margin. So I just think that the outlook for these sorts of businesses is a little scary. And we saw, for example, Calibre floated, this time last year at $1.65. And fell and then rose, and even in January, February this year it was $1.65, and then today it's 30 cents. It's down about 80% from its float price of a year ago and its share price of January 2013. So, it's telling you a really scary story.
All right, we'll move on to our next caller, who's Bert from Melbourne. Welcome to the program, Bert.
Thanks for taking my call.
Happy to.
What I was interested in was Codan, CDA,
yep,
and Swick, SWK. Codan, a lot of the directors seem to be buying the shares just lately. I was wondering whether that was significant. And the other thing was Swick, they've been buying back a lot of shares. They've got drilling contracts in Portugal, Canada, and with Fremont in New Guinea, I think.
All right. Well, let's have a look at the Codan. I think you know something about this, don't you, Rog? I'm sorry. No?
I'm off the bench today.
You're off the bench, yeah.
Look, Codan. It's a metal detection company. It's got the sort of the latest equipment. It's got enormous market share in some of the leading countries in Africa. What actually happened was in its December half-year, Bert, it announced a profit of $27.4 million net profit, and that was miles better than market anticipated. But with that announcement, it also said that its June half-year would possibly be even higher than the $27.4 million. So the stock rallied extremely hard and, in fact, got up to about $3.80, if my memory serves me correctly. We started getting a bit sceptical about it, and was quite a big hold, and we exited the entire holding, fortunately in the sort of relatively high threes. Then a few months later, with the gold price coming back towards $1,200 an ounce, and the Codan management then sort of recognising that there was some maturity going on in some of those African countries, they then announced that their June half-year's earnings wouldn't be anything near the December half-year's earnings, in fact, would be closer to $20 million or possibly even less. The share price proceeded to half, and it went from sort of 380 to, in fact, about 150. It actually fell about 60 or 65%. Now 150, we just thought it was probably a little overdone, and we re-entered, and we have a valuation of $2. Now back to Swick there, Bert. We have a valuation there of about 56 cents, but very like the entire space, the share price is below the valuation, but the outlook is a little on the frightening side. So it doesn't matter what valuations are. If the outlook is negative, the valuations will eventually come down to meet that outlook.